Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and one of the founding members of the Dividend Kings marketplace service on Seeking Alpha. And with this article, I covered 20 stocks that had some very similar characteristics. I was primarily looking for quality, so my primary characteristics were they each had to be A-rated or better, and they each had to have debt-to-capital, long-term debt-to-capital ratios below 40%. Now, I do want to point out, it was just a couple of weeks ago, maybe 3 at the most, that I wouldn't have been able to find 20 names that met those criteria. But right now I have. Now, I'm also looking for value, and valuation is extremely important. And the majority of the 20 names that I included on the list in the written portion are attractively valued. And I'll be covering 3 of those, or give you 3 examples of those today. But as I mentioned in the article, there are 2 that I still don't believe are attractively valued. Well, let me say it differently. I don't think they're as attractively valued as I would prefer them to be, but they are attractively valued relative to their historical norms. And the first one I'm going to cover is Automatic Data Processing. Clearly one of the highest quality companies on the list, AA rated, has 17% long-term debt to capital, and I might point out it does offer a 3% dividend yield, slightly above a 3% dividend yield. This was as of yesterday's close. But it does trade at a blended PE over 20. Now, I like a PE of 15, but let's analyze this company and make a couple of points that I want you to understand. Clearly, the market has a penchant for applying a quality premium to this stock. I would call the intrinsic value of this stock a 15 PE. It's an 8.5% grower over this time frame. It does have an impeccable dividend record. It has a pretty decent dividend payout ratio. Last year it paid out about just a little over half, 56% of their dividend. The dividend has grown at a very attractive rate. If we real quickly check performance, you can see that they've averaged just at 14% a year average dividend growth and compound average growth rate of 13.8. So by any standards, this is an extremely high quality company. However, when I look at its historical performance, even though the market has applied a premium valuation to it, I do want you to notice that in the recession of 2001, it did, or at least in 2002 and 3, it did come down into a valuation of 15 times earnings, and then it stayed up here at about an 18 PE. This blue line on this graph on this time frame is a normal or average PE, a blended trimmed average PE of 23. So it has traded at around 18 times earnings. Going into the Great Recession, it did get down into a 12 and 13 PE ratio, but then most of the other time it's traded above a 20 multiple, above 23 actually, for quite a few of those years. And now we've had this correction in the market, and you can see it's now fallen to a blended PE of 20. So from that point of view, the stock looks attractive relative to its historical norms. Now, if I measure other things like operating cash flow, and usually when I see premium valuations like this, I can get better valuations on operating cash flow. Now, when I look at ADP from a standpoint of how the market has historically valued it, it wasn't unusual for the market to value it at 15 times operating cash flow, but it's been at a premium valuation even above that, since 2013 or 14. So this stock is one that you very rarely find at what I would call extremely attractive. It's relatively attractive now compared to how it's been for the last 2 or 3 years. And then the final thing I want to look at here is its normal price to EBITDA, if you will. And historically, this stock is traded at around 15.3 times EBITDA. It's currently at 14.3 times EBITDA. So that would make an argument for good valuation. But I also want you to notice that as you come through these recessionary periods, the valuation does drop. Here we got down in April of 03, it was down at an 11 price to EBITDA. And during the Great Recession, it wasn't uncommon for it to trade at 9 and 10 times EBITDA. And it's currently at 14 times EBITDA. So the point is, it's definitely a lot better value, in my opinion, than it was the last couple of years. But this is one of those few stocks that I've always admired. The historical operating record is impeccable. The dividend record is impeccable. But I have almost never, I did own it many, many years ago, but in recent times I've rarely had a chance to buy this stock because I've never been able to find it when I had money available that I considered it to be attractive. So I did want to spend some time pointing out that even though we've had a correction in the market, this stock is maybe fairly valued today, but not cheap. With my second example, I'm going to take a look at Walt Disney. Now, again, premium valuations historically. The market does like and is willing to value this at a very high valuation. However, I also want to point out that there have been times, if you're a patient investor, where you could buy this stock at what I would consider to be an earnings yield in excess of 6.5 or 7%. Even after this recent correction, Disney's still only available at about a 5.59%, we'll call it 5.6% earnings yield and a dividend yield of 1.8%. Now, clearly, Disney's a lot better buy than it was, coming into the new year here, and we have had a significant correction. But again, I don't necessarily consider this stock real cheap. If I look at it from an operating cash flow point of view, which is another good way to value stocks, I see that it has traded historically at around 12 times operating cash flow. There is this big drop in operating cash flow. I do want to point this out because clearly Disney does own a cruise line, and they did close most of their theme parks during this crisis. So I did have a bad operating year last year, and we don't really know what the estimates are really going to look like. I've got some estimate data here, but obviously there's going to be damage done to Disney. So is Disney cheap enough or not? I would like to, allow you to make your own decision on that. But I do want you to notice the relationship between cash flows and stock price over the long run on Disney. And again, I wouldn't consider this one excessively cheap at this level, although it's certainly a lot more attractive than it was. Now, I do hope y'all are picking up on the fact that I'm pointing out here that I've got very similar quality characteristics here. A-plus rated stock again, 26% long-term debt to capital on PACCAR. But I do want you to notice this is a very cyclical company historically. I do want you to know their dividend record is spotty. That they always pay a dividend, but they've cut it over times, and then they raise it again when the stock is doing well. The stock is real cheap relative to earnings. You can buy it at just under 9 times earnings with a dividend yield of about 2.25% and a very attractive earnings yield of 11.3%. It's A-plus rated with 26% debt, but the point I'm making here, this is a much more unpredictable company than even Disney or ADP, which of course I mentioned has an impeccable record. When I look at it from a standpoint of normal price to operating cash flow, this stock has historically traded in the 9 to 10 operating cash flow. This blue line is an operating cash flow of 9.35. You can see it's trading at just under 7 times operating cash flow now. So from a standpoint of operating cash flow, the stock does look very, very attractive. But on the other hand, it's a very, very cyclical stock. So even though it has quality rating, low debt, it does have different fundamental characteristics than the other two that I've shown you. Now, the next one I want to go through is Raytheon. Now, I've been covering General Dynamics quite a bit here over the last year. I would put Raytheon in the same category. Of course, it's in the same industry. It's A-plus rated, has 22% debt. Thanks to the correction here, you can buy it at about a 3% earnings yield and a dividend yield of 2.8% with an earnings yield of 9.05%. So I believe it's very, very attractive here. You can see that, the best time to buy this stock is when we get it below a 15 PE. When I look at it from a standpoint of some of these other metrics, I continue to see that the company looks very, very inexpensive based on cash flows. The cash flows do cover the dividend quite nicely. So Raytheon is one that I would consider to be very attractive here. I think if you bought this stock for the long run, the dividend is safe. It's, got all the quality characteristics you would need, and I believe you would make money as long as you had a long-term outlook. But again, it's quite different than the other stocks that I've shown thus far. The next one I want to look at is Snap-on, the tool manufacturer, tools and hardware. And again, if I look at it from an operating cash flow point of view, the stock looks extremely inexpensive. And the dividend is well covered, although, occasionally it got close here. If I look at it from a standpoint of adjusted operating earnings, the stock, is trading at a significant discount to its adjusted op. And once again, I think if you bought this stock and held it for the next 3 to 5 years, you would do very, very well. Again, the company's A- rated, 21% long-term debt to capital, a dividend yield in excess of 4%. Thanks to this correction. Anyway, in closing, the long and short of it is, this correction has brought stocks into really attractive valuations. Some of the higher quality stocks that were, the market was pricing at very high valuations have certainly gotten a lot more reasonable looking and perhaps attractive looking. But I do still want to suggest that you need to pick and choose. You need to look at each stock based on its own individual merits. I'll be covering several other stocks because this market has brought a lot of opportunity, and I want you all to see the opportunity, but I also want you to be realistic and recognize that not all stocks are good buys today. Anyway, this has been Chuck Carnevale saying thanks for watching. I really appreciate it, and we'd ask you to consider the Dividend Kings, where we give stock recommendations right now on valuation. A lot of happy subscribers there. Thanks for watching.